financial management with Sanjeeva Gurve sir.
Right. Okay. As I mentioned earlier, financial management. So this is module after cover. So this is a very quantitative something, right? But we are going to learn. Right. We are going to discuss several very important topics which are useful in making finance decisions for the organization and also for personal finance decision. So this will be very useful, right? First of all, to get an idea about this module, right? Because we know all the organizations have to make finance decisions, right? Sometimes we know even some organizations operate without profit motive. We learn, right, in accounts also, non-profit organization. But they also need to make finance decisions because they may operate with the objective of giving the best benefit to the members. To do that, they need to make finance decisions, right? They all need to make finance decisions, right? Therefore, so when you start, right, not only for a particular organization, when you start business, right, what is the first decision you have to make? When you are planning to start a business, what is the first decision you have to make? What is the first decision, right? And before that, so whatever the form of the organization, whether it is, there are different forms, right? So if we start with the most basic level, we call it sole proprietorship, and then partnership, and then companies, right? Because if it is sole proprietorship, one person introduce the capital, make all the decisions, can use the entire profit, will have to bear the total loss. So there are number of advantages, number of disadvantages. The next level, partnership. Several partners, they collectively introduce capital, they collectively make decisions, they can share profit and losses. There are advantages compared to the sole proprietorship, but there are disadvantages. The next level, company. Who are the owners of a company? Shareholders. Shareholders are the owners, right? And directors, what is their job? They make, they do the management, so they make decisions. That means when it comes to a company, there is a difference between ownership and management. That's why, so you may have heard a concept called agency problem, right? So which we can identify in a company, right? Why? In a company there is a principal-agent relationship, right? Because owners are the shareholders, but they don't directly involve in decision making. The decisions are taken by the manager, the directors, the top management. So the management, the directors, they are making agency function. Agency function on behalf of the owners, shareholders, right? And so these main decisions we discuss here, right? These directors and the senior management, they have to make. But what is the objective? So when whatever the form of the organization, when the business starts, what is the objective? Objective is to maximize. Okay, profit is essential short-term objective, but what is the long-term objective? Right? For any organization, when the organization starts, right? Making profit is essential short-term objective, but what is the long-term objective? To grow, right? And in finance we use the term to increase the value, wealth. So that's why generally accepted the objective in finance, financial management, the maximization of shareholders' wealth. Since we mainly focus on companies, because as we mentioned, shareholders means owners. That means what is the objective? The maximization of owners' wealth. Owners' wealth. Wealth maximization is a broader objective than profit maximization. So profit maximization is essential part of wealth maximization. So like, if we analyze these two objectives, right? Profit maximization and wealth maximization, different concepts. The broader concept is wealth maximization. Profit maximization is essential part of that. It's like, economic growth and economic development. If we use some simple concepts, everyone, here. Economic growth, economic development. These two concepts, similar or different? Economic growth and economic development. We always, very often we hear these terms. Economic growth, economic development. Similar or different? Different. What is the broader concept? Broader concept is growth or development? Development is the broader concept. Growth is only one part of that. So that's what I want to mentioned here. That's why economic growth is only one part of development. Growth means what? Economic growth means what? Simply, right? Economic growth means what? Every year we hear, right? So the economic growth the country achieve like that. What is that? Economic growth means simply increasing national income. National income, what is the most commonly used term? GDP, right? GDP, gross domestic production. Economic growth means increase in production. But development is not only the increase in production. Development includes so many other aspects. In addition to the increase in production, there should be improvement in number of other areas, right? The living standard should improve, literary rate, motility rate, infrastructure, everything should be developed. So development is broader concept than growth, right? So similarly, wealth maximization. Wealth maximization is much broader concept than profit maximization. Profit maximization is essential part of wealth maximization. So that's why organization, they need to make profit, they need to grow, right? As you mentioned, right? Increase the value, wealth maximization is the broader concept. So, but these finance decisions should be made in order to achieve this objective, wealth maximization. So, right, in order to achieve this objective, organizations have to make number of important decisions. What is the first decision you have to make when you start business or even already started business in order to grow? What they have to do? They have to identify, correct? Correct? Yeah, first of all, they have to, right, identify what? We have to invest. The first decision is the investment decision. Right? So, in order to achieve this long-term objective, there should be long-term investments. Right? In many subjects, to denote this long-term, we use one common term. What is that? One common word is there which denote long-term. What is that? Capital. So, therefore, this should be capital, right? It is known as capital investment. Because in many subjects, even in accounts, if you classify expenses, you mention current expenses, capital expenses. If you see the government budget, current account, capital account. Balance of payment, current account, capital account. Capital always indicate long term. So in order to achieve this long term objective, there should be long term investment. So that's what we call capital investment decision, or simply called capital budgeting. So right, so that is probably the most important decision that should be made. First of all, organizations need to identify the correct investment, the capital investment, long-term investment, right? And that decision cannot be taken, without proper evaluation. Detailed evaluation should be there, right? So in the organization, if you are going to accept a project, before accepting, it is necessary to detailed evaluation in order to see whether this is profitable, whether this project will increase the value of the organization. So in order to do that, there are a number of finance techniques we use. Any idea what are the finance techniques that can be used to evaluate a project? Sorry? Feasibility study is done to do this evaluation, and once you do the feasibility study, which is required, and some finance techniques are used. Finance monies techniques are used to evaluate a project. Sorry? Payback period? Okay, you call that present value, that's right. NPV, payback period, what else? Right? There are some more. Right? So, commonly known as NPV, IRR, internal rate of return, and ARR. Right, that's right. So, these are the four most commonly used techniques. ARR, accounting rate of return, right? Payback period, NPV, net present value, IRR, internal rate of return. Right? So I can see some of you have the idea, but some of you may be totally new. Don't worry. Right? So you start from the beginning. And so one point I want to highlight at the beginning. So maybe already the institute, they may have informed you. For this module, we are going to use a financial calculator. We need a financial calculator. Right? Because all these calculations we can do without financial calculator. But financial calculator help us to do these calculations so easily, so quickly. Now, for example, so you mentioned about technical IR. What is that? What is IR? What is IR? Any idea? Internal rate of return. What is that? Right? So you know the meaning of internal rate of return? Right. Okay, that's right. What I told. So normally when we are evaluating a project, long-term project, so what we have to do, we have to consider whether this project is acceptable in today's term. That's why we use this term concept to mention net present value. Because when we are analyzing finance decisions, suppose we estimate the benefit, these benefits we estimate for different time periods, we can't simply add. Can we add the benefit we expect for the first year, second year, third year? Suppose we are evaluating a 5-year project, we estimate the benefit for the 5 years. Can we add this benefit for the 5 years and compare with today's investment? That is not correct. Why? What do you call it? Yeah? Because if we have the estimate for different time periods, we can't simply add these values, right? Why is that? Right? Sometimes the amount may be same, but value is not same. What do you call it? Time value of money. One fundamental concept in finance. All these finance decisions we make considering that important concept, time value of money. Not only the amounts of the cash flows, timing of the cash flows has value. Timing has value. So we need to adjust time value of money. Right? So that's why when we estimate the value for different time periods, what we should do, all these amounts we should consider in today's term. Then only we can compare with today's investment. Otherwise, right? So the amounts we are going to get at different time periods, we can't simply add and compare with the today's investment, which is not correct. So what we should do, we need to adjust the time value. Right? So that's why in this module, we are going to discuss how to adjust this time value money. Throughout this module, we are going to use that important concept. So that's how, right? Even when we are going to make the personal finance decision, so you want to see whether you should buy a share, whether you should invest in the bond. Can we simply consider, okay, these are the return we are going to get over the next 5 years or 10 years? We can't compare that with today's price we have to pay. That is not that. Right? So we need to adjust time value of money. That is not a difficult concept. And especially with the financial calculator, so you will see, you can do this calculation in few seconds. Right? And I mentioned about this simple concept called IR. IRR, manual calculation is quite time consuming. Because IRR means, internal rate of return means, a discount rate which will generate zero NPV. Zero net present value. That means when you estimate the cash flow for a particular project, to see what is the discount rate that will generate zero NPV, to calculate it manually, you need to calculate NPV twice, using two different discount rates. And approximately we have to calculate IR, approximately. To calculate that manually, it takes at least few minutes. But with this financial calculator, you need only few seconds. Right? So that's why this financial calculator, because we discussed the manual method at the beginning. Because we need to understand, because we should not totally depend on financial calculator. Right? Because always you may not have the financial calculator with you. That means if you have to do a particular finance calculation, if someone asks, we can't say, okay, today we can't do. I will bring the financial calculator tomorrow. Right? So we can't tell like that. We can do, that's why I mentioned, any calculation we can do without financial calculator. But for the exam, this exam is designed to answer with the financial calculator. Therefore, it's not possible to answer this paper without financial calculator in 3 hours. We can do all this calculation without financial calculator. So that's why we are going to discuss the concept very clearly to understand manual calculation. We start with manual calculation, then we are going to use the financial calculator. And it helps us to do the calculation so easily, and it helps us to discuss more. So that's why in this program, we are going to start with very basic concepts, right? But we are going to cover this module to a level that we cover under any finance professional lecture, right? So you will see much complicated finance calculations you can do so easily, right? And it takes only few seconds for you to calculate NPV, IRR, right? And not only the calculation, so that's why earlier, so it was explained, the calculation of these values is easy, right? I will, explain how to do this calculation using different methods, using financial calculator, using Excel, right? So easy to do these calculations, right? So therefore, you don't need to worry about these terms, this terminology. Because that's a common part in any subject. Because, right, some of you may not be very, experienced in finance, but you are experienced in some other field. So therefore, in any subject there are some special terms, terminologies there. Sometimes maybe the reason because no one is willing to say they are doing a simple job. So then what they do? They use very nice terms to impress others that the subject is difficult. But it's not difficult. If they use simple terms, everyone understands. So they use difficult terms. Right? Now, for example, so if you ask from a person from the public debt department, the central bank, so those who involved in issuing these government treasury bills and bonds, right? After the auction, if someone asks, okay, what happened to the interest rates today? Right? Maybe only after the information released, only they will tell, otherwise confidential. Right? So they will say, okay, the interest rate increased by 100 basis points. 100 basis points. Sounds nice, right? What is 100 basis points? 1%. So if they say 1%, everyone understands. So they never use 1%. 100 basis points. Right? But that is something everyone knows. So finance. Right? So we discuss, these concepts, everyone knows. Right? So nothing complicated. Right? It's a matter of, being familiar with this terminology and understand the concept, doing the calculation easily. And when you do the calculation, the more important thing, the interpretation. The interpretation. So how to make decision based on this one? Everyone can calculate IRR. What is the meaning of IRR? So I will show you how to calculate IRR in a few seconds. Using Excel, using financial calculator. So simple. Right? But what is the meaning? What is the meaning? So what is the decision that we can make based on that? That is the important. Right? So we'll discuss that. Right? And so as you mentioned, the first decision, right, is the investment decision. The investment decision, which is we call capital budgeting. First of all, you have to identify the proper investment. Once you identify the proper investment, what is the next decision you have to make? You identify what is the correct project that we should start. Then what is the next decision? Right? You identify the business. Maybe personal, right? Business you are planning to do. You identify the investment. Then what is the next point? We need to finance. We need to raise capital. You identify the investment. Then it should be finance. To finance a particular project, we have different sources of capital. What are the different sources? Okay, so that is one source under one category. Broadly, what are the two main categories? Internal or external. You can use that one. Otherwise, own capital and borrowed capital. So when you identify a particular investment to be made, you can use your own money, you can use borrowed money. In accounts, in finance, what are the two terms you use? Own funding, you call it. Yeah, share is one component under that. What do you call that? Capital. You call it equity. You call it equity. Or you can use borrowed capital. What is that? Debt capital. So there is option to use either equity capital or debt capital. So there are advantages of using equity. There are advantages of using debt. Right? So we'll discuss because here, since we have very limited time today, so all these points we'll discuss in more detail. Right? So the organization has the ability to finance the investment using either equity or debt. The company should identify what is the best combination. Right? So in accounts you calculate ratios like debt to equity ratio. Right? So here it is necessary to identify what is the best capital structure. That's why the second decision is called the capital structure decision, financing decision. Investment should be identified, capital budgeting, then it should be financed, the capital structure. And after that it should be continuously managed. And that is called working capital management, short-term financial management. Right? So these the three main questions. The three main questions the organization has to make, which is this objective of the maximization of shareholders' wealth, right? what long-term investment should you make, and where will you get long-term financing, and how will you manage everyday financial activity. And these three decisions are known as capital budgeting, capital structure, working capital management. The three main finance decisions, right? We'll discuss these three decisions in detail, right? To achieve this objective of the maximization of shareholders' wealth, these are the three decisions: capital budgeting, capital structure, and the working capital management, right? The correct investment should be identified, it should be financed, and then it should be continuously managed. So these decisions should be taken with detailed evaluation. So that's what we are going to discuss in detail, right? How to make this capital budgeting decision. So the cash flow should be estimated, then it should be evaluated, and there can be situation the company has a number of good investment, but they can't accept all the investments. That's what we call capital budgeting. You know that there is a budget, there is a maximum amount allocated for new investment. Therefore, subject to that budget, the correct investment should be identified, and that is what we call capital rationing. So there are a number of finance techniques. So if you are not familiar with this term, don't worry. We are going to start from the beginning, right? But you will be able to calculate all these values so easily, right? So when you you will see, right? So now once you make this capital budgeting decision, so it's necessary to identify the correct capital structure, the financing decision. Whether to finance using equity, whether to finance using debt. You know what are the equity sources and the capital sources. We are going to discuss, right? What are the advantages? What are the disadvantages? How to calculate the price of share? How to calculate the price of bond? We are going to discuss about equity valuation, bond valuation, right? So which are important not only for personal, so not only for business finance decision. So if you are planning to buy shares of a company, so how to make that decision? So if you are going to plan to invest in a bond, debenture, so how to decide that? We are going to discuss. And let's talk about the issues related to bonds in our country. That controversial bond, or the bond scam, right? So we'll discuss. So all the real information we have, right? And good capital management, short-term financial management, right? So the overview of this module. So you can see, as I mentioned earlier, very much interrelated. The topics in this subject are not isolated topics, right? So which are taken from here and there, very much interrelated. Very much interrelated. So that's why, it's important to understand from the beginning. When you understand from the beginning, there is no any difficulty. But if you miss something, then it will be difficult because these are quite related. Because following this program is not like watching Mega Telegram. Mega Telegram, or you may miss a couple of months, and if you start, you haven't missed anything. But here it's not like that, right? Because these topics are very much interrelated, right? So therefore, the proper understanding about the initial part required, right, to discuss the balance. So that means, in other words, the proper understanding about the initial part will help you to understand the balance part so easily, so much interrelated, right? So, and you can see all these finance decisions involve money, and so and as we discussed earlier, time value money we have to adjust, and to adjust time value money, we need to know about various interest concepts. So we are going to discuss about various interest concepts which are very important: compound interest, effective interest, real interest, continuous interest, right? So these terms, as I mentioned earlier, may be new to some of you, but not difficult. We'll discuss, and you can see the practical application, the important. So therefore, we are going to start with, this module, right? After the introduction, we are going to start with financial mathematics. So which will give you the proper understanding how to do these various finance analysis. When, with the proper understanding about financial mathematical concepts, which we'll discuss at the beginning, right? You will see all these topics can be discussed easily. All the calculation in these topics can be done easily, right? And for this, finance decision, we are going to talk about financial assets, right? Financial instruments like shares, bonds, debentures, and we are going to talk about the evaluation of capital investments. And when it comes to investments, so even so our friend from the previous batch also he mentioned. So we are going to talk about risk and return. We are going to talk about risk and return because when you are going to invest your money, so right, so you need to know, right, when the organization is going to invest their money, so they need to know what is the return that can be expected what is the risk they have to fix. So we are going to talk about risk and return. And when you are going to make your make investment, normally you don't invest your entire capital in one asset. You invest in portfolio, number of assets. So we are going to talk about portfolio theory, portfolio management, right? And various models, finance model, capital asset pricing model, which will be very helpful for you to make finance decisions, right? So these are not only important for the finance professionals. These are important for any manager, right? Anyone to make in finance their decision, right? So that's why earlier mentioned this finance required not only for finance professionals, all the stakeholders. You all have to make decisions, right? And in order to make decisions, right? So these the proper understanding about these concepts will definitely help you do it very well, right? And so therefore, in this module, right? So these areas we are going to discuss, and so we have only 20 sessions, only 20 3-hour sessions. So you can see the area we have to cover fairly broad. So therefore, every session we are going to cover a considerable part, right? So in other words, when you attend for the lecture, so after sacrificing many things, right? So I will not let you to regret for spending those 3 hours. Because every session we are going to cover a considerable part, right? So therefore, within these 20 sessions, we are going to cover this entire syllabus with the revision, right? So we'll discuss and we'll revise and we'll do past paper questions. And as far as exam is concerned, when you have a really good study text, the institute, right? So they are using very good study text, and at the end of every topic, we are going to do number of questions at the end of that chapter. So you will see when you get that study text, there are set of questions at the end of the chapter which will give you the opportunity to understand that topic very well, right? So it's really good study text. So for my finance exams, I have used several finance books, but this study text is really good one, because the question included in the study text, right, can help you to understand the concept so clearly. Really good question, right? And during this session, we are going to do all the questions, right? And we are going to complete 3 past papers, right? So with the when you practice those questions we discussed, there are not very difficulty in the exam, right? But the exam is easy only if you practice. Right? So even though it was given, okay, it's so easy, difficult to fail. Difficult to fail means you will fail only if you don't practice it. Right? So but you can't expect to get through the exam. Right? So if you are going to do the first question in the exam, so that's why I have mentioned during the classes, right? If you are going to do the first question in the exam, Kulu Durga, no need to check the results. Definitely fail. Right? So definitely fail. No need to check the results. Right? So but if you practice, right? So this is not difficult. Because that's why I mentioned you can't improve finance just by reading the answers. You can't improve finance by looking at someone else doing the calculations. You need to do it. You need to practice. Because especially when it comes to this online classes, because physical classes of course very much maybe more interesting. So they do all the calculations we can see. But sometimes in online classes, we can't see whether they are doing it. Because I use Excel sheet to do all these calculations. When everything is there, so at the end of the class, right, some of them ask, okay, can you share the Excel sheet? Right? But so it's good to refer it, right, for additional knowledge. But you should not totally depend on that. So you need to do the calculation. Right? So when you do the calculation, you understand, you will see the subject is interesting, right? And so when you calculate it correctly, right? So you will feel happy, and you can see a lot of difficult, complicated calculations you can do so easily. So therefore, please get this financial calculator, because there are different types of financial calculators, but it's better, right? Because if you use this one, so it's FC 100B, and I think the institute may have already communicated to you, FC 100B. Or FC 200B. So you can use this calculator, right? So as you FC 100B, FC 100B or FC 200B. FC 100B is sufficient, but if you have 200 feet, so you get that, that's also okay, right? And this is a really good financial calculator, because there are different types of financial calculators, the functions are different, so therefore if you have different types of financial calculators, then it will not be easy. But here, this is very user-friendly one, because I have used some other financial calculators also, but this is the easiest one and very good one, and because some calculations included here, not included in some other financial calculators. So this is really good. Lot of calculations. Now, maybe in mathematics you have calculated values like standard deviation. Standard deviation. If you see the formula, that's quite detailed. Take, look quite completely, right? Because standard deviation. The possibility that the actual value deviates from the expected. Actual value minus expected value, squared value to the probability, right? Then getting the sum and calculate the square root. Bit complicated. But with the financial calculator, you need few seconds. Right? So that's why I mentioned. So you need to, we need to get familiar with this financial calculator from the beginning. So that if you buy it soon, then it is good, because from the first session, we are going to do the calculation. Right? From the first session, right? So we are going to do the calculation. Therefore, and the important thing, please ask questions at any moment. Right? Because here, that friendly environment should be there. So any question you have, you should ask at any moment. Right? You can ask any question at any moment, because you need to be very, clear about this initial concept when we are moving to the other key topics. Right? Therefore, any question you have, please ask at any moment. And so you need to understand from the beginning, because at the end of this module, end of this program, so I want you to get a complete idea about this module. Right? Therefore, I will make every possible effort. So in addition to the study text, I have prepared some additional materials which will be shared. All these study materials I use here will be available in that online portal for your reference. Right? So therefore, so any question you have, you can ask at any moment. Right? And especially these online classes, I expect, because usually it's CMA class, because I have done online lecturing for some other programs also, but always I consider CMA as the best one, my favorite program, right? Because mainly due to the active participation of these the participants. So I hope you will continue it, right? Especially those who join online session, so that active participation is so important, right? So any questions for the moment? Right. Okay, then so we'll start from the next week, right? And I want you all to get complete idea about this module at the end of this module. Right. Okay, thank you so much.